Your state unemployment left you out to dry for 2021. We're gonna go over the 5 things you need to know about unemployment when you do your taxes in 2022. Number 1, the 10,200 does not exist anymore. That was a tax law that was passed by Biden in 2021 for your 2020 taxes. It does not have effect on your 2021 taxes that we're filing now in 2022. So that is not going to be a saving grace for everyone that received unemployment. Take that out of your mind. Number 2, the pandemic unemployment that you received in 2021 is going to kill you. It's going to hurt you. And there's a reason why. The states did not have the power to withhold taxes on all your unemployment. Your unemployment in 2021 had a mixture of regular unemployment from your state and pandemic unemployment from the federal government. The federal government has a clause called the Supremacy Clause, and it's inside the Constitution that basically says that the states do not have the power to override federal law. In addition to that, a lot of the states indicated their technology was not up to par to withhold taxes on the pandemic amount. There was an act that was approved by Congress called the Consolidation Appropriation Act that gave you an additional pop-up during the year in 2021 for your unemployment. That PAU was certified by Congress, and per the Supremacy Clause, the states couldn't withhold taxes on it. In this first example, this client received $14,000 in change from unemployment. It looked good, but when we did his taxes, he owed money. He could not understand why. So I said, check it out. What we realized that inside that $14,000, he had his state of New Jersey unemployment and he had the PAU. As you can see, the New Jersey unemployment was around $8,000 and he did the right thing. He withheld 10% tax. But the pandemic amount, that pandemic amount from state of that he got, that had no tax withheld. And now he is owing taxes right now and he is mad because he did the right thing. And this could happen to you. Don't just think this is a state of New Jersey thing and forget about it. No, all 50 states are going to have this issue. If you look at this example, this person received unemployment from the state of New York of about $10,000 and change. When we broke it down, the unemployment from New York is about $4,000, and what he did the right thing. He withheld the 10%. But once again, that pandemic unemployment, is just creeping in and snatching your throat and making you hang out to dry. In this last example, this is PA. Once again, it's all 50 states. The PA sends you a pandemic amount and no taxes are withheld at all. So I know you're like, what? Okay, thanks for telling me. Thanks for busting my bubble and making me have a bad day. But what we're going to do, and that brings us into number 3. The first thing that you need to do is file your taxes as soon as possible. Do not be that person that puts its head in the sand and tries to ignore it, especially if you know what's going on. File your taxes now. Get in front of it. If you owe, you want to know now. And that brings us to number 4 on the list. You want to file as soon as possible because between now and when the tax season officially ends on April 18th, 2022, if you pay that tax between that window, you pay no interest and you pay no penalties to the IRS. Yes, no interest and no penalties to the IRS whatsoever because penalties and interest start as soon as it hits midnight on April 18th. 2022, the penalties and interest start. So that's why you want to file early, and that's why you want to get it early so you can start making payments. So number 4, start making the payments. The IRS has really easy ways to make payment. They have an ACH way where you could go on to the IRS website. I dropped a link down there, and you could pay through your bank account with no fees. And you can keep on making those payments until April 15th, and hopefully you can wipe it out. And that brings us to number 5. Bum, bum, bum. Number 5 is if this is already going on with you and you can't make those payments, go onto a payment plan with the IRS. The payment plan does not stop interest or penalties from accruing, but it does stop any collection action. There's 10 different payment plans that the IRS has. I'm not gonna go over all of them with you. I'm gonna tell you about the two biggest ones that I think you should be taking care of. One is a short-term payment plan. With the short-term payment plan, you have two options. You can call up the IRS. Hello, what up, IRS? I need a payment plan for 180 days. Can you give it to me? Yes. You know why? Because the IRS automatically has to give you that payment plan if you call. It's called a short-term payment plan. The great thing about that plan, there is no fees to set up the plan. Usually your fees start anywhere from $25 to $225. So this plan, the short-term one, you don't have to pay any fee. If you go online, you won't get that 180 days, but you get 120 days. Better than nothing. But once again, penalties and interest still accrue. And the problem with penalties and interest with the IRS is that they are the mafia. It accrues every single day. It is compound interest. The penalties is every month, 5% every month until you reach 25%. So it's not crazy. The second plan is the long-term payment plan over 6 years. I know you're thinking 6 years, that's jail time. No, you don't have to do 6 years. It's like a credit card. They'll give you a minimum and they'll take it and they'll put it over the 6 years. You can pay more than the minimum if you want to. The only thing about that plan is that they have fees. The fees start anywhere from $31 to $225. To get to the low end, you have to do it online. You have to tell the IRS you want to pay them out of a bank account, and then they will do $31. To get to the $225 fees, you basically file it by paper and you say, I'm gonna send you checks, IRS. I ain't gonna be paying you when you need to get paid, bruh. I'm gonna send you checks. The IRS is gonna charge you a fee of $225 to set that up. But once again, interest and penalties accrue. The long-term plan, the interest and penalties are going to be longer because it's compound interest. It's compounding every day. Whereas the short-term plan, you pay less interest that 120 days to 180 days because its compounding is lower. The point is, if you have unemployment and you're looking at it and you see 10% tax being withheld and it's not 10% of what it is, you may have the issue that's going to be plaguing almost 25 million Americans this year. Do not run away from it. This is Carlos Fraser from Taxable Tips, and take care of yourself. Hello, IRS? I don't want to pay anything. That's actually what's going on. I don't want the 180 days and I don't want the 120 days. I just don't want to pay a damn cent. What's up? You know where I live? Come on, check me. Pull up.
Be strong.